Good day everyone, I am Casey Linancheta, and for today's lesson, we will discuss Chapter 14 entitled Fraud and Error. Our table of contents is an introduction about the topic, types of misstatements, the fraud triangle, and risk factors arising from misappropriation of assets, then risk factors arising from fraudulent financial reporting. Lastly, responsibility for prevention and detection of fraud. Let's proceed to our topic. Introduction. In the previous chapters, corporate governance has been described as the process by which the owners and various stakeholders of an organization exert control through requiring accountability for the resources entrusted to the organization. These chapters introduces fraud risks and errors and how they can be reduced if not totally avoided by having effective internal control, a tool of good corporate governance. Let's first define the definition of fraud. Fraud is an intentional act involving the use of deception that results in a material misstatement of the financial statements. Karamihang nangyayari yung fraud if madali kang maniwala or magtiwala porque may sinabi lang siyang matatamis na bagay, but that doesn't mean it is true. Before tayo maniwala, we need to conduct a research and proofs about that certain thing, especially sa financial statements. A common type of criminal fraud is the obtaining of property by giving a check for which there are insufficient funds in the signer's account. And other examples of fraud are identity theft, phishing, bribery, and etc. There are two types of misstatements relevant to auditors' consideration of fraud. Letter A is misstatements arising from misappropriation of assets, and letter B, misstatements arising from fraudulent financial reporting. So let's proceed to the next slide. Intent to deceive is what distinguishes fraud from errors. Auditors routinely find financial errors in their client's book, but those errors are not intentional. So the difference between fraud and error is that error is not intentional, while fraud is an intentional act. As I've said earlier, there are two types of misstatements, which is misstatements arising from misappropriation of asset and misstatements arising from fraudulent financial reporting. Letter A, misstatements arising from misappropriation of assets. Asset misappropriation occurs when a perpetrator steals or misuses an organization's asset. Perpetrator is yung taong gumagawa ng harmful, illegal, or immoral act between in an organization assets. Asset misappropriations are the dominant fraud scheme perpetrated against small businesses, and the perpetrators are usually employees. Assets misappropriations can be accomplished in various ways, including embezzling cash receipts, stealing assets, or causing the company to pay for goods or services that were not received. Nangyayari ang embezzling cash receipts and stealing assets when employees create bills and receipts for activities that did not occur and then use the money paid for personal expenses and sometimes because of financial needs. Asset misappropriation commonly occurs when employees gain access to cash and manipulate accounts to cover up cash debts. For example, is yung manager, minamanipulate niya na pala yung financial accounts para magkaroon siya ng gains, and at the same time, binabawasan niya na din yung pera na i-record niya para hindi halatang nabawasan or may nagnakaw. The next is manipulate cash disbursement through fake companies. Cash disbursement or yung tinatawag na cash payment is minamanipulate din nila. For example, is may kikitain silang business partner, yun pala, wala naman talagang company na makikipag-meet up sa kanila. And then, steal inventory or other assets and manipulate the financial records to cover up the fraud. Inventory such as yung property, goods, in stocks, and contents of a building is nananakaw na pala, pero hindi alam ng company kasi nagagawa nila ng paraan para hindi sila mahuli. Let's proceed to the next slide. Misstatements arising from fraudulent financial reporting. The intentional manipulation of reported financial results to misstate the economic condition of the organization is called fraudulent financial reporting. Manipulating the economic condition of the organization, if intentional, is tinatawag na fraudulent financial reporting. The perpetrator of such a fraud generally seeks gain through the rise in stock price and the commensurate increase in personal wealth. Sometimes, the perpetrator does not seek direct personal gain, but instead uses the fraudulent financial reporting to help the organization avoid bankruptcy or to avoid some other negative financial outcome. Minsan din nakakatulong ang pagmamanipulate nila sa financial reporting ng company para matulungan ito and to avoid bankruptcy or negative outcome. There are 3 common ways in which fraudulent financial reporting can take place. Include number 1, manipulation, falsification, or alteration of accounting records or supporting document. Intentional nilang manipulahin and baguhin yung documents sa accounting records. Number 2 is mispresentation or omission of events, transactions, or other significant information. There are failures when it comes to doing transactions and other information that is connected to financial reporting. And number 3 is intentional misapplication of accounting principles. Accounting principles are the rules and guidelines that companies must follow when reporting financial data. Nagkakaroon ng improper way kung paano nila gamitin yung rules and guidelines ng company. So, next slide. The fraud triangle. The fraud triangle characterizes incentives, opportunities, and rationalizations that enable fraud to exist. The 3 elements of fraud triangle are: first, incentive to commit fraud. Management or other employees have an incentive or are under pressure, which provides a reason to commit fraud. Second, opportunity to commit and conceal the fraud. Circumstances exist. For example, the absence of controls, ineffective controls, or the ability of management to override controls that provide an opportunity for the fraud to be perpetrated. And third, rationalization, the mindset of the fraudster to justify committing the fraud. Those involved are able to rationalize committing a fraudulent act. Some individuals possess an attitude, character, or set of ethical values that allow them to knowingly and intentionally commit a dishonest act. However, even otherwise honest individuals can commit fraud in an environment that imposes sufficient pressure on them. The greater the incentive or pressure, the more likely an individual will be able to rationalize the acceptability of committing fraud. Next slide, meron tayong incentives relating to asset misappropriation. Include or nagagawa nila yon because of personal factors such as severe financial considerations, na-encourage silang gawin because walang considerations yung company financially. And pressure from family, friends, or the culture to live a more lavish lifestyle than one's personal earning allow for. Peer pressure para maipakita ang maginhawang lifestyle. The next is addictions to gambling or drugs. And baka naman natural lang silang ganon and addicted to illegal actions like gambling or drugs. And meron ding incentives include the following for fraudulent financial reporting. Management compensation schemes. Example is salary plus commission. This is one of the most reliable types of compensation plans. An employee who agree to this type of compensation will receive a base salary along with an additional bonus if performance hits or exceeds earning goals. Then next is other financial pressures for either improved earnings or an improved balance sheet. Next is debt covenants. Debt covenants are restrictions that lenders, creditors, debt holders, investors put on lending agreements to limit the actions of the borrower or the debtor. The next is pending retirement or stock option expirations. Personal wealth tied to either financial results or survival of the company. Greed, for example, the backdating of stock options was performed by individuals who already had millions of pesos of wealth through stock. Let's proceed to opportunities to commit fraud. One of the most fundamental and consistent findings in fraud research is that there must be an opportunity for fraud to be committed. Although this may sound obvious, that is everyone has an opportunity to commit fraud, it really conveys much more. It means not only that an opportunity exists, but either there is a lack of controls or the complexities associated with a transaction are such that the perpetrator assesses the risk of being caught as low. Some of the opportunities to commit fraud that the top management should consider include the following: significant related party transactions, or a deal or arrangement made between two parties who are jointly by pre-existing business relationship or common interest to commit fraud in a company. The next, a company's industry position, such as the ability to dictate terms or conditions to suppliers or customers that might allow individuals to structure fraudulent transactions. Management has a unique ability to perpetrate fraud because it frequently is in a position to directly or indirectly manipulate accounting. It often involves management override of controls that otherwise may appear to be operating effectively. And the next, management's inconsistency involving subjective judgments regarding asset or accounting estimates. Then, simple transactions that are made complex through an unusual recording process. Kasi nagkakaroon ng pagbabago sa kung paano nila i-record yung transactions. Next is complex or difficult to understand transactions such as financial derivatives like yung commodities, precious metals, currency, bonds, and stocks, or special purpose entities. Next, ineffective monitoring of management by the board, either because the board of directors is not independent or effective, or because there is a domineering manager, or non-participative. Next, complex or unstable organizational structure. And lastly, weak or non-existent internal controls. Let's proceed to the rationalizing the fraud. For asset misappropriation, personal rationalizations often revolve around mistreatment by the company or sense of entitlement, such as the company owns me, by the individual perpetrating the fraud. Following are some common rationalizations for asset misappropriation. Ito yung mga dahilan or explanation ng mga taong gumagawa ng fraud or nagnanakaw, pero this logical reasons is not appropriate. Una na dito is, fraud is justified to save a family member or loved one from a financial crisis. Next is, we will lose everything, family, home, car, and so on if we don't take the money. And the next reason nila is, no help is available from the outside. Next is, this is borrowing and we intend to pay the stolen money back at some point. Yung hihiramin niya lang daw muna yung pera, pero hindi na pala niya isasoli pagkatapos ng ilang months or taon. The next is, something is owned by the company because others are treated better. So, dito tingin niya is, walang or hindi siya nakikita sa company nila. Hindi siya napapansin, kaya nagnanakaw na lang siya ng assets ng company. And the next is, We simply do not care about the consequences of our actions or of accepted notions of decency and trust. We are for ourselves. Yun yung mga explanations nila kung paano nila nagagawa yung pagnanakaw ng asset ng company. Next slide is, for fraudulent financial reporting, the rationalization can range from saving the company to personal greed and may include the following. The first one is, this is one-time thing to get us through the current crisis and survive until things get better. Number 2, everybody cheats on financial statements a little. We are just playing the same game. Number 3, we will be in a violation of all of our debt covenants unless we find a way to get this debt off the financial statements. And lastly, we need a higher stock price to acquire company XYZ or to keep our employees through stock options and so forth. Risk factors contributory to misappropriation of assets. Misappropriation of assets involves the theft of an entity's assets and is often perpetrated by employees in relatively small and immaterial amounts. However, it can also involve management who are usually more able to disguise or conceal misappropriations in ways that are difficult to detect. Misappropriation of assets can be accompanied in a variety of ways, including embezzling cash receipts. For example, misappropriating collections, accounts receivable, or diverting receipts in respect of written off on accounts to personal bank accounts. Next is stealing physical assets or intellectual property. For example, stealing inventory for personal use or for sale, stealing scrap for resale, colluding with a competitor by disclosing technological data in return for payment. Next is causing an entity to pay for goods and services not received. For example, payments to fictitious vendors, kickbacks, paid by vendors to the entity's purchasing agents in return for inflating prices, payments to fictitious employees. Then, next is using an entity's asset for personal use. For example, using the entity's asset as collateral for a personal loan or a loan to a related party. Misappropriation of assets is often accompanied by false or misleading records or documents in order to conceal the fact that the assets are missing or have been pledged without proper authorization. Next slide, incentives or pressures. Personal financial obligations may create pressure on management or employees with access to cash or other assets susceptible to theft or misappropriate those assets. Number 2 is adverse relationships between the entity and employees with access to cash or other assets susceptible to theft may motivate those employees to misappropriate those assets. For example, adverse relationships may be created by the following. Letter A, known or anticipated future employee layoffs. Letter B, recent or anticipated changes to employee compensation or benefit plans. And letter C, promotions, compensation, or other rewards inconsistent with expectations. Let's proceed to the next slide, which is letter B, opportunities. Number 1, certain characteristics or circumstances, susceptibility of assets may increase to the misappropriation. For example, opportunities to misappropriate assets increase when following situations exist. Letter A, large amounts of cash on hand or process. Letter B, inventory items that are small in size, of high value or in high demand. And letter C, fixed assets which are small in size, marketable, or lacking observable identification of ownership. Let's proceed to number 2. Inadequate internal control over assets may increase the susceptibility of misappropriation of those assets. For example, misappropriation of assets may occur because of the following. Letter A. Inadequate segregation of duties or independent checks. Letter B. Inadequate oversight of senior management expenditures such as travel or other reimbursements. Letter C. Inadequate management oversight of employees responsible for assets, for example, inadequate supervision or monitoring of remote locations. And letter D. Inadequate job applicant screening of employees with access to assets. Letter E. Inadequate record keeping with respect to assets. And letter F. Inadequate system of authorization and approval of transactions. Letter G. Inadequate physical safeguards over cash, investments, inventory, or fixed assets. Letter H. Lack of complete and timely reconciliations of assets. Letter I. Lack of timely and appropriate documentation of transactions, for example, credits or merchandise returns. Letter J. Lack of mandatory vacations for employees performing key control functions. Letter K. Inadequate management, understanding of information technology, which enables information technology employees to perpetrate a misappropriation. And lastly, letter L. Inadequate access controls over automated records, including controls over and review of computer systems event logs. Let's proceed to letter C, which is attitudes or rationalizations. Number 1. Disregard for the need for monitoring or reducing risk related to misappropriation of assets. Number 2. Disregard for internal control over misappropriation of assets by overriding existing controls or by failing to correct known internal control deficiencies. And number 3, behavior indicating displeasure or dissatisfaction with the entity or its treatment of the employee. Number 4, there are changes in behavior or lifestyle that may indicate assets have been misappropriated. And lastly, number 5, tolerate of petty theft. The risk factors contributory to fraudulent financial reporting. Fraudulent financial reporting may be accomplished by the following: manipulation, falsification, including forgery or alteration of accounting records or supporting documentation from which the financial statements are preferred. Next is misrepresentation in or intentional omission from the financial statements of events, transactions, or other significant information. Intentional misapplication of accounting principles relating to amounts, classification, manner of presentation, or disclosure. Fraudulent financial reporting involves intentional misstatements, including omission of amounts or disclosures in financial statements to deceive financial statement users. It can be caused by the efforts of management to manage earnings in order to deceive financial statement users by influencing their perceptions as to the entity's performance and profitability. Such earnings management may start out with small actions or inappropriate adjustments of assumptions and changes in judgments by management. Pressures and incentives may lead these actions to increase to the extent that they result in fraudulent financial reporting. Such a situation could occur when due to pressures to meet market expectations or desire to maximize compensation based on performance. Management intentionally takes positions that lead to fraudulent financial reporting by materially misstating the financial statements. In some entities, management may be motivated to reduce earnings by a material amount to minimize tax or inflate earnings to secure bank financing. Next, fraud, whether fraudulent financial reporting or misappropriation of assets, involves incentive or pressure to commit fraud, a perceived opportunity to do so, and some rationalization of the act. Letter A. Incentive or pressure. Incentive or pressure to commit fraudulent financial reporting may exist when management is under pressure from sources outside or inside the entity to achieve unexpected and perhaps unrealistic earnings target or financial outcome, particularly since the consequences to management for the failing to meet financial goals can be significant. Next, fraud, whether fraudulent financial reporting or misappropriation of assets, involves incentive or pressure to commit fraud, a perceived opportunity to do so, and some rationalization of the act. Letter A. Incentive or pressure. Incentive or pressure to commit fraudulent financial reporting may exist when management is under pressure from sources outside or inside the entity to achieve unexpected and perhaps unrealistic earnings target or financial outcome, particularly since the consequences to management for the failing to meet financial goals can be significant. Let's proceed to letter V. Opportunities. A perceived opportunity to commit fraud may exist when an individual believes internal control can be overridden. For example, because the individual is in a position of trust or has knowledge of specific weaknesses or internal control. Fraudulent financial reporting often involves management override of controls that otherwise may appear to be operating effectively. Fraud can be committed by management overriding controls using such techniques. Number 1 is recording fictitious journal entries, particularly close to the end of an accounting period, to manipulate operating results or achieve other objectives. Number 2 is inappropriately adjusting assumptions and changing judgments used by estimate account balances. Then, omitting, advancing, or delaying recognition in the financial statements of events and transactions that have occurred during the reporting period. And then, concealing or not disclosing facts that could affect the amounts recorded in the financial statements. Next, engaging in complex transactions that are structured to misrepresentation the financial position or financial performance of the entity. Then, last is altering records and terms related to significant and unusual transactions. Let's proceed to the next slide, which is rationalizations. Individuals may be able to rationalize committing a fraudulent act. Some individuals possess an attitude, character, or set of ethical values that allow them knowingly and intentionally to commit a dishonest act. However, even otherwise honest individuals can commit fraud in an environment that imposes sufficient pressure on them, just like what I've said earlier. Let's proceed to our last slide, which is the responsibility for the prevention and detection of fraud. The primary responsibility for the prevention and detection of fraud rests with both charge with governance of the entity and management. It is important that management, with the oversight of those charged with governance, place a strong emphasis on fraud prevention, which may reduce opportunities for fraud to take place, and fraud deterrence, which could persuade individuals not to commit fraud because of the likelihood of detection and punishment. This involves a commitment to creating a culture of honesty and ethical behavior, which can be reinforced by an active oversight by those charged with governance. In exercising oversight responsibility, those charged with governance consider the potential for override of controls or other inappropriate influence over the financial reporting process, such as efforts by management to manage earnings in order to influence the perceptions of analysts as to the entity's performance and profitability. So that's all. I hope you learned the differences between fraud and error, the types of misstatements, the fraud triangle, and risk factors arising from misappropriation of assets, then the risk factors arising from fraudulent financial reporting, and lastly, responsibility for prevention and detection of fraud. Thank you for watching and for listening.